Hi everybody, welcome to the basics of generation skipping transfer tax. This is part 19. So we're getting close to the end of this series. We'll have one more installment after this, but this is perhaps one of the most important, I think, in my opinion, subject matter pieces within the GST tax itself, because it strikes at the heart of what a lot of people assume works in a certain way, but doesn't actually work in the way that it's intended. And that's the rules around the creation of separate trusts and qualified severances and how they affect the GST tax treatment of trusts that are indeed being divided into separate shares. Now, before we get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, this is a follow-up to our last discussion, because last time in part 18, we looked at some of the high-level principles dealing with the allocation of GST exemption at death. And it's often the case that at death, as I introduced, that you might have testamentary trusts that are created, or even an inter vivos revocable trust that becomes irrevocable. And all these different trusts might be created at death that each require their own allocation of GST exemption. It may even be the case that we have inter vivos irrevocable trusts that are divided up at death. So with that division, the question is, how do you treat those from a GST tax perspective? So overall, what we're going to look at is a default rule. Then we're going to dive into some exceptions under the Treasury regulations, which deal with the GST tax. Now, before we get started, I had contemplated breaking this out into multiple parts, but I think because of the subject matter, it helps to look at it holistically and how the two different sets of regulations we're going to look at interact with each other and where they apply. Now, before we get into those Treasury regulations, it's important to note that typically in this situation, you have GST exemption being allocated to one trust, and then when that trust is divided, in the eyes of the GST tax rules, typically that trust as divided is still viewed as one trust in terms of the GST tax attributes. So what does that mean? It usually means that once a trust is divided, then for GST tax purposes, one, any taxable distributions have to be made proportionately from each subtrust. Two, each subtrust will have the same inclusion ratio as the master trust had before division. Three, any GST election, like the reverse Q-tip election or the election to treat a trust maybe as a GST trust, would be deemed to be made for each subtrust and not allocated individually to one subtrust at the expense of the other. And then also any future allocation of GST exemption would be made proportionally to each subtrust. So it's really those 4 points that we're looking to tackle here. And really the big ones are going to be the inclusion ratio before and after division, and also the treatment of taxable distributions and where they're sourced from. And those are perhaps two of the biggest tools you have in planning around separate trust and separate share rules. So to avoid all 4 of those default rules, what we end up doing is looking to 2 separate sets of regulations. First, we have 26.2654-1. These really apply in situations where the creation of separate trusts are mandatory, either under the trust instrument or based on the structure of the trust as being clearly separate and independent shares. Then we have another regulation, which is 26.2642-6, which really applies to a situation where a trustee has the discretion to create separate trusts either under the trust instrument or under local law. But the difference between the two is that in the first set of regulations, by the happening of an event or other terms and conditions, the trust has to be divided into subtrusts, whereas under the second, under what we're going to come to find out are the qualified severance rules, we're going to see that the qualified severance rules apply in a situation where the trustee does have that discretion to divide. So in situations where these rules don't apply, the default assumptions above those 4 GST attributes will typically apply before and after the division to determine the GST tax treatment of each subtrust or separate trust that is created. And that treatment will continue until the transferor is changed, if that ever happens. And that will be the subject for next time. But let's dive into these regulations. So first, we can look at the question of whether there are indeed separate and independent shares. And it may be the case that starting off, you have one trust that isn't actually divided under the terms of the trust instrument or by the trustee, but mechanically, the way the trust is set up is that the shares of different beneficiaries are clearly separate and independent. So for example, you might have a child and grandchild who receive equal income during the trust term, and at the end of the trust term receive equal principal. So in that case, their interests are clearly equal and thus separate and independent. So what that means is that this one trust could automatically be treated as separate trusts under the first set of regulations. So what that would mean here is that in this example, only the income distributions to the grandchild would be taxable distributions, and they'd only be deemed to come from the grandchild's separate and independent share. Similarly, only the distribution of principal to the grandchild at the termination of the trust would be a taxable termination. And you could assign GST exemption differently to each of these trusts so that the share for the grandchild could be made exempt through a zero inclusion ratio. However, additions to the single trust would be allocated equally to each separate and independent share unless the trust instrument said otherwise. So that's perhaps the one snag you have in this treatment. Now, the trustee's authority might not change that treatment. This would really be dependent on the terms of the trust instrument and whether they expressly direct the trustee to make an allocation of additions to the single trust in a way that is different from pro rata to the separate and independent shares. Now, perhaps the most confusing rule in all of these regulations that we're going to deal with are the rules around pecuniary amounts that could be distributed from a trust. And these are going to tie into the funding of a trust as well. Now, if you're familiar with formula clauses, you're used to the concept that, for example, if one spouse dies, there might be a formula under the documents to allocate the unused estate tax exclusion to a bypass or credit shelter trust, with the balance going to a marital trust. So there's often a lot of debate over whether that formula creates a pecuniary amount that goes to the family trust, or whether the formula allows fractional shares of assets to be allocated to each, and what are the nuances in that. The other third option is often that you can take the assets and divide them up on a fairly representative basis based on the net appreciation or depreciation that is accumulated since the last valuation date. Now, all three of those issues are going to pop up here, but we're going to look at this first in the context of a clear example, which is a revocable trust that becomes irrevocable at death. So the trust calls for a $1 million distribution outright to a grandchild, with the balance then going to children in separate trust shares. So, in this example, the question is, could that $1 million pecuniary bequest be treated as a separate share or a separate share of the revocable trust? And the answer is yes, but some requirements have to be met. And what's at stake here is the question of whether that pecuniary bequest could have its own separate inclusion ratio from the rest of the revocable trust. And it may seem intuitive that it can, but there are some requirements that have to be met. One, interest has to be paid on the pecuniary distribution between the time of death and the time of distribution. And the GST tax regulations require either interest accruing at the statutory rate under state law, if that's required, or it requires a permutation of between 0.8 and 120% of the 75/20 rate from the time that that pecuniary bequest becomes payable. Now, the question is, do you have to satisfy this in cash? And the answer is no, but if this pecuniary bequest is paid in kind, there's another requirement. Either you have to use the value of the in-kind assets on the date that the distribution is actually made, or you have to look to the last valuation date, and in that case you can only distribute assets in kind that are fairly representative of the net appreciation or depreciation that is accrued in the trust since the last valuation date. So for example, if you're administering an estate, you get a date of death fair market value, and it takes you 15 months to get around to making this pecuniary bequest, then one, you have to accrue interest for those 15 months, and two, if you pay it in kind using the value as finally determined for federal estate tax purposes, you can't choose any asset. You would have to choose an asset that is fairly representative of the change in value since the date of death. So we're going to see this theme pop up in other situations, but first we're going to jump similarly under the first set of regulations now to a situation where there are multiple transferors. And this is pretty clear and intuitive, but if there are multiple transferors for GST tax purposes, the trust may be broken into separate shares based on the contributions of each respective transferor, and each of those separate shares would be a separate and independent share for GST tax purposes. So what that means is, primarily, each transferor would independently allocate their own GST exemption automatically or manually to each of those deemed separate trusts, even though this is a contribution maybe to one trust. Similarly, additions to a transferor's existing share would redetermine the fractional shares that are deemed here based on the initial contributions, and two, a redetermined fraction based on the value of the trust at the time of contribution. Next, we get to mandatory severances. So we're going to look at mandatory severances either due to a condition or due to the death of a transferor or other person. But the death of a transferor or other person is going to have its own set of rules which apply based on whether the trust is included in the gross estate of the transferor or is funded with assets in the gross estate. So to clarify, this set of rules is going to apply when you have a trust that's divided and it's not included in the gross estate of the person who brings about this condition or the transferor. So what we have here is a situation where the terms of the trust themselves call for a separation of the trust into separate shares, where there's an event or condition that occurs outside of the trustee's or any other person's discretion. And in this case, if the terms of the trust call for this mandatory distribution, then each trust may be treated as a separate trust for GST tax purposes. So that could be a condition under the trust or at the death of an individual such as the transferor. But again, if the death of the transferor is coupled with the inclusion of the trust assets in the gross estate, you would not use this set of rules. You're going to use this set of rules on the next slide, which there's not much difference between, but we're going to look at this one first. So for mandatory severances, in order to be separate, there has to be a funding mechanism under the trust or local law that meets these requirements. One, if you have a funding formula that has a pecuniary allocation to a subtrust, then we go back to those interest accrual and valuation or fairly representative pieces that we looked at on the last slide. Now, if there's any other funding other than pecuniary, typically we have to use a fractional share basis where each asset is divided fractionally between the two trusts pro rata. Now, you could use a non-pro rata to allocate whole assets in kind, but if you do so, you either have to use the value of each asset determined on the date of funding, or you have to use a fairly representative formula in order to make that allocation looking back to the last valuation date. Next, we have discretionary severances, where we're going to look at this from the perspective of the trustee having the discretion to divide up the trust. Now, we're moving on from the first set of regulations now into a second set, 26.2642-6, which is going to apply to what's going to be known as the qualified severance rules. So what we're going to look at as a whole is we're going to back up from the concept of qualified severances and look at this more in the vacuum or bubble of severances of a trust that the trustee has discretion to make either under the terms of the trust or under the terms of state or local law. But this is a situation where we don't have a mandatory trust severance. So in order for discretionary severances to be respected for GST tax purposes, you typically have to meet one of the following conditions. Either the trust is included in the gross estate and severed before the due date for the estate tax return, including extensions, and that's applicable regardless of whether the tax return is filed, the estate tax return. However, as we discussed in the last part, Part 18, you may want to file for GST exemption allocation purposes among the separate shares. The other possible condition is that the severance is a qualified severance. So what is a qualified severance? Well, qualified severance is going to apply in any situation where you're dividing based on the trustee's discretion and the trust assets are not included in the gross estate of the transferor and aren't being severed due to the transferor's death. So these new regulations are going to have a number of requirements for qualified severances, the second set of regulations, I should say. Now, really what this boils down to, in all scenarios where there's a severance that's discretionary and not mandatory, you have to have a qualified severance in order to have a differing treatment of shares of a trust for GST tax purposes, checking off all four of those characteristics we looked at the beginning. So usually where you're going to see this applied is in a situation where a trust has an inclusion ratio between 1 and 0. That's going to be the most common characteristics we check off here. So what this allows under the qualified severance rules is for you to sever a trust into a share where one has an inclusion ratio of 0 and another has an inclusion ratio of 1 based on the date of severance value. So why might you want to do this? Well, it allows you to create an exempt and non-exempt share. And then afterwards, since this is respected now as separate trusts through the qualified severance, this would allow you to then make taxable distributions from the non-exempt trust that has an inclusion ratio, or really make them from the exempt trust, I should say, that has an inclusion ratio of 0, instead of allocating taxable distributions pro rata from each separate share. And if you have any trust with a 0 or 1 inclusion ratio, the severed shares will have the same inclusion ratio, 0 or 1. So you might do that in a situation where you want to have differing GST tax elections. But either way, there are some requirements. We're going to breeze through and try to check off the major boxes at the top of the bell curves. But one, we have to have, before and after the severance, a succession of beneficial interests that in the aggregate are the same for the combined trust and the resulting subtrusts. And that's easy to meet if the terms are the same, but in looking at this, you have to be aware of the formula because you can divide along generational lines, but what the regulations call for is resulting interests that use a per capita division. So there's a big rabbit hole we can go down with that I'm not going to dive into here, but there are some examples you can look at in the regulations. And much like you would have with any sort of modification to a trust, there's some boxes to check where, 1, you cannot shift interest to lower generation beneficiaries than those that exist under the current trust, and 2, you cannot extend the perpetuities period of the trust through the division. If you fail any of those requirements, you don't have a qualified severance. Now, in making a qualified severance, the trustee has to pick an effective date and stick to it. So you pick an effective date, and as we're going to see, you take a value as of the effective date, and then the funding of the separate shares has to commence as of that effective date, and it has to be completed within 90 days of that effective date. From a funding and valuation perspective, we have to take a value as of the effective date. So we have to use funding, again, on a fractional basis, or non-pro rata based on the values on the date of severance and not based on the last valuation date. Now, ironically, in this, you're creating separate shares, and when you're taking the value as a whole, what you're going to create are fractional shares that could generate a discount based on lack of control or lack of marketability or both. But in using this value, you cannot claim discounts based on the fractional funding. Now, when we're using a qualified severance as opposed to a mandatory severance, you can't allocate or divide based on a pecuniary amount or based on fairly representative funding if you're using an older valuation date. However, you could use a formula based on a transferor's unused GST exemption. So the question you might have is, what's the difference between basing this on the unused GST exemption versus the pecuniary amount? And it's a fine hair to split that we're not going to get into here, but largely what that means is that a lot of formulas based on unused GST exemption, or the amount necessary to create a zero inclusion ratio, are going to be fine. Then finally, if the inclusion ratio is not 1 or 0, you have to allocate to 2 or more separate shares, and you have to use that, again, based on the date of severance, fair market value, but you have to do so in a way where all of the resulting shares have either a 0 or a 1 inclusion ratio. So the biggest piece in this is perhaps the reporting. If you're going to have a qualified severance, then what you must have the trustee do is file Form 706 GS parenthetical T by April 15th with extensions of the year following the year of the qualified severance. So to do this, there is a procedure in the regs, which I'll direct you to, but the high points of it are that you have to write qualified severance at the top of the Form 706 GST. You have to include with that form a self-drafted notice of qualified severance. Now, there's a number of items of info that have to be included in that notice. Things like the transferor, the identifying info for the original trust, the identifying info for the resulting trusts, and the funding of each trust and the formula that's going to be used and what assets are going into each resulting subtrust based on the value that's reported with this return as well. So the big difference and question is, what happens if you don't have a qualified severance? If you fail any of those requirements and you simply don't want to go through this process. So if you have a situation where you have a discretionary severance that is not qualified, you can still create separate trusts that are respected for GST purposes, which check the 3 boxes, but it doesn't check a 4th box. The inclusion ratio will be the same for the 2 trusts that are created, or each trust that's created if you divide into more than 2 trusts. But you only have that treatment as long as the severance is recognized for state law purposes. So for most states that recognize the Uniform Trust Code or other similar laws, you're going to have a state law that allows a trustee to divide or combine trusts along similar terms and lines. So with that being said, resulting trusts from a non-qualified severance can still allow the other 3 boxes outside of the inclusion ratio to be checked. That you can allocate taxable distributions to one separate trust instead of the other. You can make different GST elections for each trust, and you can allocate GST exemption after the division to one separate trust at the expense of the other. However, this doesn't affect anything that happened before the division. So if you pick an effective date for the division, and if you had a taxable distribution or taxable termination in the same year, you couldn't retroactively allocate that distribution or taxable termination to one separate trust after the division if that termination or distribution happened before the effective date of this severance. So I know this was a lot of material to take in, but here are kind of the condensed takeaways I have for this subject. One, it's helpful to have language in a trust that authorizes everything we've looked at here. One, a division of the trust for any purpose, and for that matter, a division of the trust for GST tax purposes. Now, when you have that type of language, and even a discretionary severance, you have to be conscious of the funding formula that's used. Pecuniary funding may not work, and even if it does, there's an additional requirement under the GST tax regulations requiring accrual of interest and at a statutory rate. So keep in mind, you only get that pecuniary funding if there is a mandatory severance or if the severance is based on clearly separate and independent shares based on the terms of the trust. So you don't get the pecuniary funding in a discretionary division situation. But speaking of, you can still have a discretionary severance even where the trust is silent if your state law, like the UTC or something else, gives the trustee that authority. Now, interestingly, on the pecuniary interest piece, you have to be aware of the issue that some states may not require interest to accumulate under pecuniary gifts. that might be made under wills or trusts. For example, Colorado recently updated their Uniform Principal and Income Act to now say that there can be interest for pecuniary bequests under wills, but not under trusts. So ironically, Colorado, you can get around the pecuniary interest piece by using a revocable trust. But that doesn't get around the GST tax regulations that require interest to accumulate on a pecuniary bequest or funding. And finally, you have to keep in mind that if you want a qualified severance, there's many hoops to jump through, including a tax filing and the midstream valuation as of the effective date of the severance. And there's no discounts for the fractional shares of assets that are divided between the resulting subtrusts. So what's coming? We're close to the end. We're going to have one more part 20, which is going to deal with transfer shifts, and then some other basis and special rules that can apply. And then we're going to move to a second phase of this, which is going to be more of a case study that will look at GST exemption allocation on Forms 709 and 706, broken down by popular transfers and popular situations. So here's our glossary of terms thus far, which we're probably not going to add to after this point. We've already introduced qualified severance, and I've bolded that again to emphasize that for you, but that's still on the list, and you have more color to that now. Thank you again for listening to this video and this series for that matter. If you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this video, and I look forward to seeing you in my future content.